All right, this is a week dominated by central bank speak. We've got Jay Powell, the head of the U.S. Fed, set to make some comments later today. The markets will be watching very closely. Ahead of that, kind of a muted market picture. And then, of course, we have a Bank of Canada decision tomorrow, although we've already had a pretty strong indication from the bank that they're going to hold tight for now because we're still trying to figure out how far these interest rates are going to impact the economy. And let's get some perspective on what that means for investors. Chhad Aul, Chief Investment Officer at Sun Life's SLGI Asset Management, and he joins us here in studio. It's nice to see you, as always.
Great to be here.
I don't know. I mean, nobody really knows the answer of how far you have to go to fight inflation and where the economy lands, but we have to make some decisions for now. I mean,
right.
do you feel like everything is going as according to plan as it could?
I suppose, I mean, we've seen in Canada certainly a little bit of weaker economic data, which I think reinforces the need to pause. But south of the border, even over in Europe, last couple of economic prints in the course of February been a little bit hotter than expected and kind of increased rate hike expectations in other parts of the world. So, the pause, I mean, it's been well telegraphed. It would be pretty surprising if the Bank of Canada did not go ahead with that. But it'll be interesting to see how much divergence can they really have against other central banks. Obviously, that would weaken the Canadian dollar, which on its own becomes inflationary. So, there is a lot to watch here. But, the approach of eventually hitting a pause, I think, makes sense for most central banks as we have to watch these rate increases kind of work their way through the real economy.
Yeah, I have a follow, but I just want you to explain to our audience that Canadian dollar factor.
Sure.
On the inflation front.
Yeah, absolutely. I mean, obviously, if the Bank of Canada is pausing, other central banks hiking rates, let's just talk about the Fed, for example, that spread between interest rates is going to have the U.S. dollar gaining against the Loonie, right? And then it reflects inflation in two ways, really directly on imported goods. Obviously, a good chunk of our consumer basket here in Canada, based on goods we're importing, Canadian dollar is falling, those are more expensive. Even on the export side, if our dollar is falling, kind of ramps up demand for our exports.
And and to your point, we're likely going to hear we're holding pat for now from the bank this week, and then today everyone's going to be making conclusions on what Jay Powell's plan is going forward. But there's already this expectation we've got more U.S. rate hikes, and I wonder, the subject of stagflation came up earlier this hour with Ed Devlin, that if the Bank of Canada wants to avoid a worst case scenario for economic weakness, maybe they're justified for now. But what if you can't control the inflation beast and the game of ping pong they have to play as a result?
Absolutely, and I think that's why a conditional pause is kind of the term that's used. The next move is equally likely to be a move up, then probably most likely is a long pause. Now, stagflation, it's a good point, and we've been saying for a while that the data could feel like stagflation in this early part of the year because inflation data is lagging in nature, so that may still show some strength. Whereas a lot of the leading indicators that we look at on growth, again, more leading in nature. So that just given the sort of the time differences, we could be in a period where it feels like stagflation, but if we're focused much more on the leading nature of data, I think we are in the camp that we are going to see a slowdown, a necessary slowdown that ultimately helps to rein in this inflation.
So how's that impacting your investment decisions? Like, are you willing to put money to work in the stock market in this environment?
I mean, we will make tactical plays based, when we see overshoots on extremely, negative sentiment. We will play against the herd from that perspective. But generally speaking, we are concerned about fundamentals in the equity market. Earnings, again, not really pricing in those sort of economic slowdown that we think will come through, given the sheer scale of monetary tightening that we saw last year.
Can I just run something by you? I mentioned it at the top of the show, but I've been thinking a lot about it because we had a guest, Ed Clissold of Ned Davis Research in recent days, who said, look, usually for a bear market, and it's complicated when we're talking U.S. versus Canada, but let's just use the U.S. market. For a bear market to truly reach its endpoint, you got to wait more than a year, typically after the last rate hike. And at this point, that would take us well into 2024 for the end of a bear market, assuming that's how things play out. But he also pointed out, but because the market in the U.S. peaked in January of last year, you basically saw the bear market begin a couple of months before the first rate hike,
right,
which is unusual. It's usually about 7 months in. And I just wonder if the bulls have a case that everybody is a little too hypersensitive right now, considering the correction that we already saw last year?
It's a fair point. And often when you use those sort of historical analogies of how long things have lasted, those could change marginally, right? We know obviously, like, everybody's looking at that data. They're going to be a little bit more reactive this time around, right? So the research is out there. But I think it's a good point to then step back and look at, what's priced into the market? Where are valuations today? What's the risk premium on equities? What kind of slowdown in earnings are expected?
And do you think is there still too much premium in stocks for such an uncertain environment?
There is certainly
or at least
a case to be made, and certainly when you see, bond yields at the levels that they are today, risk-free rates where they are today, there's a case to be made that you're not really earning enough on equities. So that's another case that you need to pay very close attention to, sort of these absolute levels versus, of course, all the historical analogies. Real
quickly then, since you mentioned yields, on fixed income, you nibbling there?
Absolutely. I mean, we're seeing yields, spike higher in this 4% range, say on the U.S. 10-year. We think these are good opportunities to add some rate exposure, add some high-quality bond exposure to the portfolio. Again, what we expect to do well in that severe kind of case where we do see an economic slowdown, we do see recessionary concerns, we do see a slowdown in earnings in the equity market.
Okay.